The ugly side of digital lending. In their mission statements, Africa's fintechs often use the tagline, "Doing X for the unbanked or underserved," where X is the financial service they provide. But digital lenders are one of the few fintechs that actually do what they say they do. Before them, traditional lending was broken, and low-income Africans without access to financial services had no access to credit. But in the last decade or so, digital lenders have changed all that. These lenders don't have the same regulatory restrictions as traditional banks, which has allowed them space to innovate. And one of their biggest innovations is digital credit. But what is digital credit? Unlike traditional banks, digital credit makes use of non-traditional data to determine creditworthiness. So, whereas a bank would rely mostly on financial histories to make a credit assessment, digital lenders rely mostly or entirely on non-traditional data to make a similar assessment. Now, some of that data is self-reported by the applicant, while the rest of it, things like call logs, social media activity, and even text messages, are accessed directly from the applicant's mobile phone. Lenders then run the applicant's data through their algorithms and decide on loan applications. This is how digital credit gives the people without financial histories access to loans. Another advantage of digital credit is that the loan application decisions are often automated. Borrowers don't have to wait for days or weeks to know their fate. They also don't have to make trips to a bank branch or see any bank staff. However, it's not all rainbows and butterflies. Digital lending does have its bad and ugly sides. The first is that there are lenders that give money to people who are willing to pay, but don't necessarily know what they are paying for. This is typically known as predatory lending. Here, the borrower is enticed into taking loans with terms that look good on paper. But if they look a little closer, those loans might have interest rates or lateness fees that are abnormally high. The devil, as they say, is in the details. The second problem is lenders that give money to people who are willing to pay, but not necessarily ready to pay. This often happens when a lender's algorithm doesn't do a proper credit assessment of the applicant, and the results aren't pretty. Studies have shown that when compared to traditional lending, digital lending has higher default rates. And it's no surprise. With predatory lending on the one hand and poor credit assessments on the other, borrowers often end up in situations where they struggle to repay their loans. And when they are unable to pay, this snowballs into some lenders employing aggressive debt recovery methods, such as harassing guarantors with phone calls and messages. And when this doesn't work, it then snowballs into debtors ending up on blacklists and being prevented from taking loans from other lenders, whether digital or traditional. This blacklisting can be dangerous, especially in the long run. Picture this. If a borrower defaults on a loan of 20,000 Kenyan shillings, that's less than $200 by the way, and that borrower gets blacklisted, they may be prevented from getting a mortgage in the future, even if, first, they were a poor fit for the loan to begin with, and second, they've become a good fit for a mortgage over time. That's the reason why many have called for digital lending to be regulated. And three problem areas that have been identified are: 1. Improving the credit assessments by digital lenders. 2. Stopping predatory loans. 3. Preventing lenders from contacting the people on the contact list of defaulters. Without these controls, digital lending will continue to solve long-standing problems for Africans, while potentially creating new problems that could be long-term.